The stock market has been on a wild ride lately, with some investors feeling bullish about the future, while others are worried about an impending crash. One voice that has recently weighed in on the issue is that of Warren Buffett, one of the most successful investors of all time. In this video, we'll be exploring Warren Buffett's warning about the impending stock market crash and what it could mean for investors. Before we dive into his warning, let's take a moment to appreciate the magnitude of Warren Buffett's success. He's consistently beaten the market for decades, and as of 2021, he's worth over $100 billion. In fact, his company, Berkshire Hathaway, has seen an annualized return of 20.8% since 1965, compared to the S&P 500's annualized return of 10%. With this kind of track record, it's clear that when Warren Buffett speaks about the stock market, people listen. So let's find out what he has to say. Warren Buffett is a billionaire investor and CEO of Berkshire Hathaway, one of the largest and most successful companies in the world. Born in Omaha, Nebraska in 1930, Buffett developed an interest in investing at a young age and made his first stock purchase at the age of 11. Buffett attended the University of Nebraska and later transferred to the University of Pennsylvania's Wharton School, where he earned a degree in economics. After graduating, he went to work for his mentor, Benjamin Graham, at Graham-Newman Corp., where he learned the principles of value investing. In 1956, Buffett started his own investment partnership, which eventually evolved into Berkshire Hathaway. Over the years, Buffett has become known for his long-term investment strategies and his ability to spot undervalued companies that have the potential for growth. Thanks to his impressive track record, Warren Buffett is widely regarded as one of the most successful investors of all time. His investment philosophy is followed by many, and he's often sought out for his insights on the market and the economy. In fact, he's often referred to as the Oracle of Omaha for his prescient market predictions and investment acumen. In May 2021, Warren Buffett made some headlines when he warned of an impending stock market crash. During the annual Berkshire Hathaway shareholder meeting, Buffett cautioned investors about the potential for a market downturn, saying that people should watch out for inflation and that inflation is the enemy of the investor. Buffett's warning was prompted by a number of factors, including rising inflation rates, high valuations of stocks, and increasing debt levels. He expressed concern that the Federal Reserve's low interest rate policies could lead to inflation, which would erode the value of cash and other investments. Buffett also noticed that the stock market had become overheated, with many companies trading at historically high valuations. He warned that investors should be cautious about investing in companies that are overpriced and urged them to focus on buying companies that have strong fundamentals and long-term growth prospects. While Buffett's warning about the stock market crash may be concerning to some investors, it's important to remember that he's not always right and that his predictions should be taken with a grain of salt. Nonetheless, his insights into the market are highly respected, and his warning underscores the importance of being aware of the potential risks and taking a balanced approach to investing. Despite his warning, Buffett has remained optimistic about the belief that the US will continue to be a great place to invest, and that companies with strong fundamentals and a long-term vision will continue to thrive. As an investor, it's important to take a long-term perspective and to understand the potential risks and rewards associated with any investment. By staying informed and maintaining a diversified portfolio, investors can mitigate the risks of a market downturn and position themselves for long-term success. Why is Warren Buffett's warning important? Investors should pay attention to Warren Buffett's warning because of his track record as a successful investor and his insights into the market. Buffett's warning highlights the potential risks associated with an overheated market and the importance of being cautious and disciplined when investing. His words can help investors to make more informed decisions about their investments and avoid making costly mistakes. A stock market crash could have significant implications for both individual investors and the broader economy. A sharp downturn in the market could lead to a loss of investor confidence, causing many to sell their holdings and exacerbating the decline. This could lead to a broader economic recession, with job losses and decreased consumer spending. Individual investors could also suffer significant losses if they are heavily invested in the stock market. Those who are close to retirement may be especially vulnerable, as they may not have enough time to recoup their losses before needing to rely on their investments for income. However, it's worth noting that a market crash is not inevitable, and that many experts believe that the market will continue to perform well in the long term. Nonetheless, it's important for investors to be aware of the potential risks and to take steps to protect their investments in case of a downturn. In conclusion, Warren Buffett's warning about an impending stock market crash should be taken seriously by investors. By staying informed and taking a balanced approach to investing, investors can position themselves for long-term success and weather any potential market downturns. What can investors do to protect themselves? Investors who are worried about a potential stock market crash can take several steps to protect themselves. One important strategy is to maintain a diversified portfolio that includes a mix of stocks, bonds, and other investments. This can help to minimize the risk of losses in any one sector or asset class. Another important step is to avoid making emotional decisions based on short-term market fluctuations. Instead, investors should focus on their long-term goals and investment strategies and make decisions based on sound financial principles rather than fear or greed. Some specific strategies that Warren Buffett has used in the past to protect his investments include investing in companies with strong fundamentals, focusing on companies with a long-term vision, and avoiding companies that are overpriced or have unsustainable business models. Buffett has also emphasized the importance of investing in businesses that are easy to understand, have a competitive advantage, and generate strong cash flows. By investing in companies with these characteristics, investors can position themselves for long-term success and weather any potential market downturns. Ultimately, the key to protecting oneself from a potential stock market crash is to remain disciplined and focus on long-term goals. By staying informed about market trends and risks, and by taking a balanced approach to investing, investors can position themselves for success in any market environment. Another strategy that investors can use to protect themselves is to invest in index funds or exchange-traded funds, ETFs, rather than individual stocks. This can help to minimize the risk of losses in any one company, as these funds are designed to track the performance of an entire market or sector. Investors may also want to consider working with a financial advisor who can provide guidance and help them to create a diversified portfolio that aligns with their goals and risk tolerance. In conclusion, while no one can predict with certainty when a market downturn may occur, investors can take steps to protect themselves by maintaining a diversified portfolio, avoiding emotional decision-making, and focusing on long-term goals and sound financial principles. By following these strategies, investors can position themselves for success in any market environment.